Good morning. Welcome to Prescient's webinar on credit and insight into the South African credit market. My name is William Vulani, and with me presenting our views on credit in the South African credit market is Sithembiso Garane, credit portfolio manager and structuring specialist. Can move over to the next slide, Sithembiso. Yeah, so who is Prescient? So Prescient is a diversified financial services group, which was founded in 1998. As at the end of July, we're sitting at 102 billion in assets under management. Our current BE level is level 1, and our black ownership is 53.8%. In terms of the breakdown of assets, we can see that the bulk of our assets are in the interest-bearing space, split between cash mandates, income bonds, and also we manage multi-asset class portfolios and equity mandates as well as global mandates. There's just some of our stats in terms of our BE and transformation numbers across the business. And there's a Q&A session as well. So if you've got questions, you can just type the questions up in the Q&A, and at the end of the session, after Sithembiso has spoken and presented, we will then take questions which Sithembiso will answer. There'll be 15 minutes for questions. For those that are also joining us, who've received a link via Batseta, the industry body, if there's any other information which you require from Prescient, or you don't have anyone that you're dealing with currently from Prescient, you can kindly drop us an email at info@prescient.co.za and someone will get in touch with you. Thank you, and over to Sithembiso.
Thank you very much, Vuyo, and thanks everyone for joining us in this webinar today. So what we're going to be talking about today is obviously the overview and delving deeper into the insights of the credit market in the country. But what we wanted to do was to first, talk about credit as an instrument, just to backpedal a bit, and the dynamics of credit as an instrument. So normally companies would go and fund themselves in the market either by a way of equity or by raising debt in the market. So the benefits to a lot of companies is that your debt reduces your weighted average cost of capital, and it is very important that companies balance the mix between equity and debt. So what as institutional investors would do is to conduct a thorough due diligence into these companies to assess their credit worthiness, upon which, when we think that they are credit worthy, then we'll dispense the money that we get from our clients, and all the financial returns then accrue to our clients. So now in credit as an asset class, you have different levels of risk. There is structural subordination in the balance sheet of the corporate companies. And you would know that other than common equity, you have your credit, and then your credit then is clustered into different instruments. You have senior secured debt in the form of it can come in the form of a government guaranteed instrument. It can come in the form of secured assets for property companies, especially. Then they would want to go into the market and raise money using their property assets as security. But if you're a government institution, normally such as an ESKOM, then you would use your parent company, which is a government, to actually secure you. But it's not only limited to government institution. Certain companies that are subsidiaries of bigger international companies normally would come into the market and want to utilize the strength of their parent company to actually raise debt. Some of the examples that come to mind will be your Mercedes-Benz South Africa that uses the guarantee that they get from Daimler in Germany, or a Toyota South Africa that would use the Toyota Group International, the Japanese company. And you have normal senior unsecured debt. That is basically when we as lenders go directly to the counterparty and lend it purely based on its standalone credit quality. And further down, you have subordinated debt, largely issued by your banks and insurance companies because they are regulated to have some capital protection and issue subordinated debt. And there's also, mezzanine debt, and the preference shares that you see in the market is also, viewed as a mezz debt. So a mezzanine debt is any type of instrument that projects, both equity characteristics and also debt characteristics. Normally, a pref share would have an equity risk profile, but at the same time, it would have a debt or a credit return profile. So, which means any hybrid instruments that has characteristics of equity and also characteristics of debt, then it will be seen as a mezzanine debt. But now, just to delve deeper into the bank capital structure, is that for banks, they can issue senior unsecured paper, but at the same time, they are allowed to, or by regulation, to actually issue a subordinated debt, which is a little bit riskier than the senior secured debt. And they've got two tiers of subordinated debt. It is the tier one, additional tier one capital, and also subordinated tier two capital. So the difference between those two instruments is that upon bank resolution, so which means when the bank goes into liquidation, the holders of the additional tier one capital will first need to be wiped out before you go to tier two capital. So with the institution of the new banking regulations, Basel IV, that is still coming, we are anticipating to have a new asset class that is going to be super senior to the current senior unsecured debt. It's going to be, it's called FLAG, which is an abbreviation for first loss absorption capital. Is going to do in the structure is that it's going to further subordinate, additional tier one capital and subordinated tier two, as well as senior unsecured. So we're expecting those instrument types to be a lot riskier than they currently are, and that's supposed to be reflective on the pricing itself. So other than just going directly to the balance sheet of the corporates, the institutional investors can access credit instruments by purchasing structured credit instruments. A lot of these instruments would come in the form of your credit linked notes, your securitization notes, and also a repaid vehicle. So your credit linked notes are issued by banks. So it is a form of a bank to de-risk its credit exposure. So what it does is that a bank who has an exposure to a particular counterparty would then go into an institutional investor and sell their risk exposure that they're holding. So the difference between the credit linked note and the repack vehicle is that, so the credit linked note, the instrument itself will remain in the balance sheet of the bank, but at the same time they will transfer the risk to the institutional investor. So an investor would have dual risk. One risk will be the default risk to the underlying counterparty, and also a counterparty risk to the bank itself. With the repack vehicle is also another form of a bank to actually de-risk its credit risk exposure, but instead of just selling the risk exposure, it sells the total holdings of that. They move the exposure into a separate SPV. So you have a different SPV from different banks. So RMB, for example, they've got Inguza. Nedbank would have Indala, and then Investec has Harcourt, and a lot of others. Other banks have different SPVs. So they would move the credit exposure into that SPV and then sell down that exposure to the investor. So what the investor has is only the default risk to the underlying counterparty and not the counterparty risk to the bank itself. And now the bank has, immunize itself of that credit risk as opposed to the credit linked note. The securitization, it is when corporates would take performing assets and also move them off the balance sheet into a separate SPV and then sell notes off the back of the receivables of those performing loans. We've seen that it would either come in the form of the mortgage-backed security securities or commercial mortgage-backed securities, which is the commercial properties, and also the real mortgage-backed securities, the residential loans to individuals, and also it could be equipment rentals or credit cards. So that's a form of actually using your assets to raise more capital. So now the risk that investors have in those is on the performance of the underlying assets and not to the balance sheet of the counterparties. So one other thing that is important in credit, it is your credit rating agencies. So we currently have Moody's, S&P, and global credit ratings in South Africa currently allowed to rate. So we had Fitch, which has since left the country. So the role of the credit rating agencies in the credit market is to provide independent assessment of the corporate's ability to service its debt obligation. And then investors would then use that to make investment decisions. So each and every credit rating agency is a different methodology of assessing the credit, and that would differ per sector, and it differs per credit rating agencies. But there's one theme that is in common that they look at. They would be assessing your liquidity and profitability, your leverage and solvency, and there's a lot more other qualitative factors that they would look at, such as your governance structures and management expertise and qualification. They would also look at your business risk, your industry risk, and your economic risk. Those are very important in terms of the forward-looking view of where the corporate would land up in future. But the most important thing to also realize is that they're not bulletproof to default risk. We've seen a lot of shortcomings, especially during times of crises that came through from rating agencies. One of the examples that when Steinhoff defaulted, it was actually rated AA. So that is just 2 notches below the best rating you could possibly get, which is AAA. And when African Bank defaulted, it was rated a single A. And the most recent example would be your LANDBANK, which was a AA+. So which tells you that it's not prudent to overly rely on credit rating agencies. So in the institutional investors, it is important for them to supplement the usage of rating agencies with their own internal mechanics to actually assess risk and make that risk overlaying it with the usage of those credit rating agencies. So the major consideration that one would look at when you assessing credit and credit risk, you would want to look at the macroeconomic environment and look at the economic outlook in a specific geography within which the corporate is operating. And you would also observe certain market crises in different geographies. For example, a classic example is that there could be a global crisis that affects everyone that you cannot avoid, but certain crises will be specific to certain geographies. One example that I like to mention is the fact that MTN, which derives more than 50% of its revenue from Nigeria, there was a period where it could not even extract any revenue from Nigeria because of the shortages of dollars in that particular geography. So it does not help, irrespective of how they perform operationally, if they cannot get any money to be able to actually service their debt. So one of the things that you would want to consider is your market structure in the credit space. So it is largely affected by legislation and also regulation, and it can be affected by your technological advancement as well. So a lot of people would ask, for example, what will happen if government were to prescribe certain assets. So that's one of the legislative mechanisms that can definitely affect the credit market structure, in that it will create an artificial demand to a particular asset type In this case, if, for example, they were to prescribe all SOEs, then it will facilitate a huge demand to SOE, such that there'll be a lot of money chasing that particular asset class and neglecting the other sectors, and it could create a pricing imbalance because of supply and demand dynamics. The regulatory mechanism that can definitely affect the structure of the market, I think we've experienced that already with the Basel III requirement to the banking sector, where banks were supposed to actually hold high quality liquid assets in their balance sheet. What that does is that the SOP then tells the banks to go and participate in the credit market and buy the quality credit counterparties into their balance sheet, because those are deemed to be much more liquid, such that when the bank is in distress, it can be easily liquidated and they can cash in on those assets. So what that does, and what we've experienced it doing in the market, is that it created a lot of demand for specific counterparties that were deemed as HQLA. Those include a lot of the property counters, that is Growthpoint, Redefine, and Mercedes in the automotive space, because Mercedes and Toyota rated AAA purely because of the guarantees that they get from the international parent companies. So it created a lot of demand to specific counterparties that were deemed HQLA at the same time, which is why then you created a scenario where there is more money in the credit market. So it affected the supply and demand dynamics, because there was more money chasing fewer assets, which is why we then experienced a lot of compression in the credit space, regardless of the fact that the credit quality was deteriorating. So it was counterintuitive to what we know in the credit cycle market. So what you do also want to do is to look at the counterparty. You'd want to assess the counterparty risk of the underlying credit. So what you look at there, it will be your default risk and also your credit spread duration. So those are two different risks. Now, the default risk speaks to the credit quality of the counterparty, but your credit spread duration, it will also only speak to the amount of time you are willing to stay invested in that counterparty. An example again I would make is that if two counterparties are rated the same, or have the same default risk, but you would want to invest in a 5-year and a 10-year in another one, so obviously your credit spread duration will be much more for the longer dated one than the other one. So even though the credit quality is the same, but the longevity or the tenor risk, which is called the credit spread duration, will be totally different. But the risk assessment does not only end at the counterparty level, you'd also look at the portfolio level. So you amalgamate all your counterparties and look at your expected loss in the event that there were to be a default risk change within your portfolio, and you also look at the unexpected loss. You'd use a whole lot of quantitative methods to actually get to that value, and also that would also get you the loss given default. That is, in the event that you were to have defaults in your portfolio, how much would you lose? And the last part that you definitely consider it is your credit pricing. So there are two ways where you can actually assess, or look at the credit pricing, and they're equally important. The first one is that for the counterparties that have a mature term structure, you would want to take the bonds that are trading in the secondary market and then using those implied prices by the market and construct a price for the new issuance anywhere in the curve. But because of certain markets like the South African markets are very illiquid, and your implied pricing can definitely be wrong or out of kilter with where the market is at. So the risk-adjusted pricing, which is you would take the default risk together with the credit spread duration, and compute the fair value pricing of those credits, looking at the market dynamics, but also comparing it with the peers. So what that does, that sometimes even when your fair value is lower in your risk-adjusted methodology, you can still want to price it higher using the implied pricing, because it wouldn't help you to buy a cheaper asset in the primary market when you can go directly in the secondary market and buy it at a higher price. So on the next slide is just the outlook in the credit space currently. So what we do to consider that, we look at the economic cycle. So your credit cycle in the market mimics exactly the economic cycle. So what happens is that when the economy is deteriorating, you're expecting the credit quality to also deteriorate, because all corporates are performing or operating within that economy would then be affected by the same issues that are generic in the economy. So certain variables that we look at to indicate where we are in the credit cycle or economic cycle will be the economic growth, interest rate cycle, foreign exchange, currency, and bond yields. So when the economy or the credit cycle is on the downturn, what we generally expect is that your credit spreads should widen, because there's more risk in the economy. Companies are not doing too well, they're not being profitable. As a result, you're expecting them to find it very difficult to actually service their debt obligation. The opposite is true when the economy is on the upswing. What happens is that the economy is booming, it's producing, there's more jobs in the market, there's more money in the hands of the consumers, there's more purchasing. At the same time, businesses are much more profitable, and there's more growth, and it means that they'll continue to service their debt quite successfully. So where are we currently? We think that we've been in this position for quite a number of years now. We're still on the economic downturn. And where would you want to position yourself in this current environment is that you would want your credit view to be short and biased, so which means you would want to buy shorter dated credit instruments, and at the same time you would want to concentrate on the higher quality credit instruments. If you do go further down in the quality spectrum, you'd obviously want to have some collateral and get some security. So for example, in the property space, you'd want to get exposure to secured property. So these are the indicators that I just mentioned on the previous slide. So if you look at those indicators, they all point to the fact that we are in a deteriorating credit cycle. So corporate credit quality is supposed to be going down, and we've been seeing that for the past 3 years. But it's just that until the beginning of this year, that has not translated into the pricing of the credit. So what we saw for the past 3 years until at least early in this year is that even though the credit quality or the credit spread are also compressing, purely because of what I mentioned earlier of the HQLA buying and the inclusion of the banking sector in the capital markets that enables this demand for credit. So the only anomaly there on those indicators, there will be your inflation, which we think it is only due to the trade activity that has been stunted over the past couple of quarters. So that is just the only exception, but all the other credit cycle indicators tell us that we are actually in the deteriorating economic cycle. So what happens is that this slide then explains exactly the market themes. So when there's excess credit supply in the market, which you would see in the bottom left quadrant, that is where there's deteriorating credit quality and widening credit spreads. that is exactly where we think we are currently, if we see that arrow. So there's high probability of default counterparties, so which means there's lower credit quality counterparties in the market, and we are seeing spreads widening currently. But where do we think we were before? We think that we were on the bottom right quadrant where there was excess demand for credit purely because of the HQLA buying. So you were still in the same position when it comes to credit quality. However, because of the excess demand, the spreads were tightening. If you see that other quadrant is characterized by spread widening. So we only recently moved to that quadrant, which is not counterintuitive with the economic cycle. So what happens is that on the bottom right quadrant and the top left quadrant, those only occur when there are structural shifts in the market. But the other two quadrants, the red one and the green one, those follow the economic cycle without any structural adjustment in the market. But when there are structural issues that are actually affecting the credit market, you would then be on those two other quadrants, which is the bottom right one and the top left one. Those are characterized by you also on the short end bias on the bottom right one, and then you would want to actually go on the mid to long term bias on the top left one then. So these two slides then tell us then how would you manage risk at a portfolio level. So if you have those curve there, which we call portfolio credit risk neutral curves, it just tells you that wherever you fall within the same curve, the amount of risk exposure that you have at a portfolio level would be the same. So the two sources of credit risk, obviously, it'll be the credit quality, which is the probability of default, and the credit spread duration, which is the risk you take for term risk. So what happens is that the combination of those two risks gives you the same out portfolio risk along the same curve. So what happens is that when the structural shift in the market, so that essentially means there is no fundamental change in the risk dynamics in the counterparties. So you would also want to move along the same curve, so which essentially means you would want to change the split between the credit quality and the term premium that you have in your portfolio, because the risk still remains the same. But when there's economic swings, then the credit quality in the underlying portfolio does change. Then you would want, in that instance, to move your curve completely. So when we are in an economic upswing, you would want to be positioned to take much more risk, to be positioned for growth. So you'd move from that navy line into the red line, because you tolerant to much more risk because of corporates are improving in the economy. But at the same time, when the economy is deteriorating, then you would want to reduce your risk appetite at a portfolio level to the green line there. So just then delving deeper in what we see currently in the South African credit market. So it's important to also understand what makes up the South African capital markets or in the credit space. You see that the outstanding listed debt currently in the JSE, this information was extracted as at 30th June 2020, is that we have about R1 trillion outstanding listed credit currently, and 2/3 of that is made up of just banks and SOEs. So it just tells you how important those two sectors are. Or maybe if you look at it from the other direction, it just tells you that a lot of South African corporates are still highly reliant on bank funding. They are not significant participants in the corporate capital markets. And of the 309 billion SOE debt that is currently listed, more than half of it, which is that 186 billion, is government guaranteed. it just tells you again the contingent liability that government has on the listed space again. But what is also important is that other than banks and SOE, the only other industries that are significant, it will be the property sector, which is the REITs, and also maybe insurance, in terms of the diversity of issuers within that sector. On the REITs, you probably have 8 to 9 different issuers in that space that makes up the 40 billion. And also the insurers, because they are forced by legislation to actually, issue some capital, which is subordinated debt. So you have a pretty much diverse insurers in that space. But on the automotives, the 30 billion is only made up of 2 counterparties, that is Mercedes-Benz and also Toyota. Of that 30 billion rands, the telecoms, the 21 billion is made up of Telkom and MTN. And the same trend is the same for a lot of these other sectors. So they're not very deep. They've got 2 or 3 issuers within the same sector. And it just shows you that the South African credit market is not as developed as you would get elsewhere in the developed world, such as maybe in the EU or in the US. So there's still further room for the credit market in the country to actually grow. But if you look at the structured notes, that's 75 billion, though, and also the repacked vehicles, which is 2 billion. Those are issued by the banks. That's exactly what I just explained. The structured notes are your CLNs and also your index-linked notes. They're issued by the banks. They are a form of banks to actually de-risk their balance sheet. So it's not any specific, issuer. But underlying those CLNs, it will be one of those sectors within that issuance. Then. But one other thing that is worth mentioning on this slide is the fact that of that trillion rand, 153 of it will be maturing within the next 12 months. That is very important to consider, given the fact that we're currently in a very difficult situation where corporates find it very hard to actually refinance some of their debt. So it means that there's a huge refinancing risk within the next 12 months. These corporates would need to come back to the market and raise refinance for that maturing 153 billion. Failing which, they'll need to go to a banking sector. We think that that's going to be very difficult. The banks have shown a lot of strain as well, which is why you see an increase in the issuance of the CLNs, because the banks themselves are actually trying to de-risk their balance sheet. And it will be important to see how the refinancing activity occurs within the next couple of months. So what has happened in the credit market during the COVID period? So what I've taken is that the issuances that have happened from the beginning of this year until 30th of June, you will see that in the debt capital markets, there's been 61 billion that was issued during the first half of the year. And if you look carefully on the structured notes and the repacked notes, that's around 16 billion. So in the first half of the year, the banks have sort of de-risked their balance sheet by 16 billion. They've sold down some of the credit risk exposure to the institutional investors. So if you just take that out and also just look at the senior unsecured portion, that is about half of the issuance, which is not a lot, because the senior unsecured portion speaks to the individual corporate issuance that occurred, if also including with the government guarantee. The government guarantee, which is 60 million there, that is just Denel alone. And the only issuance that speaks to individual corporates is that senior unsecured. And the subject here too is just banks, which would exclude for now. And that 30 billion senior unsecured is made up of those counterparties at the top right chart. And when you look at it, it's actually dominated by the high quality names. The biggest issuer there, close to 12% of that amount, it's your Mercedes-Benz. and there's NetBank and MTN there. So, but largely dominated by the banks, including GrowthPoint, and the only lower rated name, the European Northern, is rated with a single A, still, good credit quality with high rating. But if you look at the fact that Northern did not issue during the COVID period, they issued somewhere in February, and a lot of the other counterparties in there that you see, they actually issued before lockdown. That includes LANDBANK. LANDBANK issued close to about $500 million. That was before lockdown. And a lot of the other property companies that you would see, they're Hyprop, Redefine, and Emira Fortress. They participate just prior to the lockdown, with the exception of Fortress, which refinanced recently. But one other thing that is very important is that the market is very reluctant to issue longer dated instrument. So almost 45% of the current issuance that has happened during the first half of the year occurred in the 1 to 3 year bucket. So which generally tells you that people do not want to take the term risk given the amount of uncertainty that we are faced with in the market. And the total number of issuance that happened between 0 to 1 year is 20%. And on the 7 year to 12 year bucket there, that is Ekurhuleni municipality, which issued a 10 and a 12 year bond, with a small contribution coming from a GrowthPoint with a 10-year bond issuance. But the majority of that issuance actually came from the city of Ekurhuleni. But general theme of the first half issuance is that, firstly, it's very difficult for a lower quality credit counterparty to actually issue in the capital markets, which means that they would be forced to actually go back to the bank funding. We do not think that they would be able to actually raise bank funding at palatable rates, because now the banks are trying to de-risk. They'll only do so if they get handsomely compensated for taking that type of risk. And also the fact that a lot of participants in the capital markets want to reduce the credit spread duration, so they want to reduce the term that they're actually exposed to in the capital markets. So as we've seen on the previous slides, that the SOE, with the exception of the banks, is one of the important sectors. It's more than 3 billion in total issuances, and it's very important to understand, and it is actually very impossible to ignore given the sheer size of the contribution that it has on the capital markets. So in this slide, just an overview of these counterparties. I'm not going to spend a lot of time on this particular slide, but what I wanted people to take out of this particular slide is that if you look on the table and the list of all the entities, it will tell you that some of them are statutory bodies, so which means they were established by an act of parliament, and all the other ones that I've highlighted in bold are actually constituted by an act of parliament. So that essentially means that they cannot be put under business rescue or liquidated by an investor upon default. So those counterparties can only be put under administration by Parliament and a respective portfolio committee in Parliament, wherein they could be dissolved or certain clauses in the act changed. We've seen this example happen with the current default of LANDBANK, when LANDBANK defaulted, but it could not be put on business rescue or liquidated by the investment community. Only Parliament and the respective minister can actually suggest that LANDBANK must be put under administration. So what that does is that it adds a further risk if you are investing in a counterparty that cannot be put into liquidation. But if you look at it from the positive side, it just tells you that the going concern risk is slightly diminished. So which means if the government does not put it under administration, it is actually forced to support it for it to continue as a going concern. We've seen this example again happen with LANDBANK, where government is actually currently contributing an equity injection such that LANDBANK continues as a going concern. So in the in the SOE issuance, so this is just that SOE issuance here. You can see that it's dominated by ESKOM. ESKOM and TRANSNET contribute 52% of the total debt that is constituted of the SOE space. And majority of the ESKOM debt is not listed. So only about 150 billion of ESKOM's debt is listed of the 450 or 430 billion that they have on their balance sheet currently. And ESKOM is very important to the credit capital markets, and it's also very important to government. The sheer size of its balance sheet, we do believe that ESKOM is as important as the banking system. So the government cannot allow and will not allow, I think, ESKOM to actually go into liquidation. So the other counterparties, as you can see, they're big, like a DBSA and IDC, but in the bigger scheme of things, when in comparison with other SOEs, they're not that significant. And the water bonds are very insignificant. That includes, DENEL as well. That's the smallest SOE that we have. So in terms of the maturity profile of the SOE debt, you will see that it is sparse across the term structure quite nicely. But one highlight that you can have is that if you look at the rectangle, which is the maturities within the next 12 months, which are around 35 billion, it's largely constituted of TRANSNET, and there's a bit of ESKOM there, and also SANRAL, but a huge chunk of the maturities come from TRANSNET. And we would be aware that TRANSNET has actually cancelled more than 2 auctions over the past 3 months. They announced auctions and canceled them because it was very difficult for them to actually raise money in the capital market. So that raises the refinancing risk specifically to the SOE sector. So TRANSNET is not government guaranteed, and I think later on we'll see that we think that is one of the counterparties that is self-sustainable when you look at its balance sheet. But I think because of the elevated risk perception by the market, it's going to be very difficult for some of these SOE to actually refinance that 35 billion within the next 12 months. So of that 35 billion, only 20 billion is actually maturing by September, end of September 2020, if you look at that cumulative graph there. So SOEs would have to come back to the market between July and September to raise 20 billion. So we haven't had any that's issued anything as yet currently. We know that the SANRAL within the next 3 months is supposed to come to the market and raise some debt, and we haven't had anything. So on the maturity profile, we see that there's a gap there's a further scope for issuance in the 7 to 12 year bucket because there's very little issuance there. The 3 to 7 year bucket is largely issued, and on the longer term, which is 12 year plus bucket, that is largely constituted of ESKOM, as you would see there on the chart, and also SANRAL with a small chunk that is TRANSNET. So both SANRAL and ESKOM are government guaranteed, and TRANSNET is not. So that tells you that for SOEs to actually issue longer dated credit, they have to get a government guarantee. Otherwise, the market perceives there to be too much a risk for them to take longer dated SOE debt. So on this slide, basically just summarizes what I just said right now, that there's very little appetite in the investment community to actually invest in SOE space. And SOE, like I've mentioned, it contributes a huge chunk in the debt capital markets and is very significant, and it cannot be ignored. What we see is that when lending is halted by the investment community to the SOE sector, it will definitely dampen the banking spread, because the other industry that is viewed as high quality or right now or a safe haven other than the SOE space due to its implicit government support, it will be only banks, because the rest of the market is also experiencing deteriorating credit quality. So it could dampen the widening of the spreads that we currently see, or it could force a premature spread tightening within the banking sector, because that is the only sector currently that is viewed as safe. And right now, due to the land bank situation, the implicit government guarantee support has diminished slightly, and there's also an increased dependency that is projected by those SOEs to government. And government has announced the infrastructure drive currently, which would boost, the economy, or at least intended to boost the economy. So as a result, they are currently in consultation for Reg 28 to be changed and increased to 30%, such that it can fund that infrastructural drive. Because these projects will be off balance sheet, maybe it will be easier to raise fund off balance sheet for SOEs. But the theme of the market is that there's a dearth of assets in the market. A lot of more issuers are disappearing from the capital markets, and there are no new entrants in the capital markets currently. So that means that we still need to go to banks to buy these CLNs as they try to de-risk, or maybe get into the market and de-risk their book. So on this slide, this is just the credit metrics of what we see on the SOE space. You'll see that Denel and ESKOM are the riskiest one, and the four on your further right, IDC, Sunroll, and Randwater and Umgeni Water, are much more high quality compared to the rest. So on the individual counterparties, our views. So ESKOM, we currently neutral on ESKOM, our view, but not neutral on its standalone credit. We negative on ESKOM as a standalone credit, but we neutral given the overlaying government guarantee, and purely because ESKOM has offshore cross default covenants that are seriously stringent, that would definitely make it impossible for government not to support ESKOM. So if you've got a government guarantee on ESKOM, I think you're in a better position, even though maybe people are talking about the fact that it could be restructured, but a restructure is a technical default, and that immediately cause a default on some of these international covenants that they have. Just on the business model, obviously it currently owns the whole value chain of the energy, and highly regulated by NASA. We've seen some of the squabbles that they've had with the regulator, which is not ideal at all. And there's also a potential disposal of sale. They've been talking about that. There's no direction as yet. So this will probably facilitate more cash coming to the balance sheet without him coming to the capital markets. Suboptimal operational structure due to high primary energy costs and also high wage bill, which they need to sort out. So, and there's significantly high gearing. There's a lot of uncertainty in terms of business model right now. So, which is why I think we are negative on ESKOM as a standalone, but at least we think it will be palatable to invest on a government guarantee basis. So on TRANSNET, TRANSNET, we still very positive TRANSNET. So you would know that TRANSNET has always recorded, good performances in terms of its, income statement, and also cash flow is highly cash generative in its business. But the only issue that they experienced was the governance issues, and also they had an audit qualification due to the locomotive tender that they got to during the state capture era. So now they've got a new management, they're changing management, they've got a new board. So it's doing all the right things from the government perspective to actually remedy the situation right now. So it's not highly regulated. It is, slightly regulated. Only 20% of its revenue is currently regulated, which is not a significant portion of its revenue stream. Regulated, that's the ports portion, and also the pipelines regulated by NESA. And the pricing is highly, linked to the commodity prices. So when platinum and your gold goes up, and then because it will be facilitating trade in those commodities, then there'll be higher revenue. So when the commodity prices go down, TRANSNET is highly likely to have little revenue on its balance sheet. So the CEO and the management have guided that there'll definitely be pressure due to the constrained trade activity that has currently happened. So on they expect lesser revenue on the next reporting period, but we still think that, as TRANSNET is highly investable, and it currently is one of the few SOEs that does not even need government support. So on the last one, just on LANDBANK obviously it defaulted. The biggest problem in LANDBANK was the fact that it spends a lot of money on the SLA book, so it has intermediaries. It borrows money from the capital market and then goes and on-lends it to the farmers, but it does not lend directly to the farmers. 60% of the money that it lends to the farmers utilizes, intermediaries, and they spend about 400 million on those intermediaries on the annual basis, and that is significantly, unsustainable. So it's got an insurance business and also the agri loan business, and it owns the 27% of the market share. Still operationally sound. So the only thing that triggered the default, obviously, was the liquidity crisis. So government will be injecting 3 billion rand before the end of this year, and would also be guaranteeing the new debt program. So we do think that post this event of default, LANDBANK would find it very difficult to re-enter the capital market and issue debt, or at least issue debt at fair levels. People are definitely going to price the fact that it had a very bad business model and could not sustain it. We think the spreads of LANDBANK would remain elevated for the near future. So it's currently junk on Moody's and still rated A- by Standard & Poor's. So the triggers, just delving deep on the triggers of LANDBANK, obviously it was a liquidity crisis that was precipitated by the fact that there was a very bad debt management in the book. They had huge shorter dated maturities that when they could not refinance those, and they had something similar to a bank run. But operationally, when you look at LANDBANK, other than the fact that it had breached the performance, the non-performing loan covenant, it still remains sound. Currently, is collecting over 7 billion a quarter in collection, which is way above its assumptions. They thought, given COVID, they'll be collecting around 60%. So they actually doing better than they had promised the market right now. But again, there was a huge management gap for a long time. There was no CEO, there was no treasurer, and there was no CFO. And that, investor community can largely attribute it to the shareholder, the National Treasury. So there was a couple of times that the board had recommended individuals and they were turned down. They had to go back and recruit, and they were turned down until we had a situation. So they defaulted in March, and then the new CEO started in beginning of March, and the CFO started in February. So there was a huge gap on important position for a prolonged period of time. So right now, there's a liability solution that is in place where it would actually just extend the maturities that the current investors are exposed to, and I think investors will be compensated for taking a longer duration currently. So just on this last slide, then on our view on credit as an asset class. So we think credit allows you to enhance your returns, obviously. by exploiting a lot of opportunities that may avail themselves in the credit market. It is a huge catalyst for growth in the market. It's very important for both corporates and also SOEs and banks. But at the same time, it does not come without risk. It's important that the manager does an intense due diligence on the counterparties and has a robust investment process that will make sure that you do not take unnecessary risk, you do not take into your balance sheet the unnecessary default risk. So at present, our process, we actually think that we have a robust due diligence that is premised on 3 quantitative models that is obviously overlaid by a lot of qualitative due diligence that we do on individual companies and also management themselves. And this gives us a proper view of the counterparty or the underlying risk on the counterparty. Currently, we're in the process of also making sure that we include, the long-term sustainability of these counterparties by, incorporating the ESG process, which is currently fully developed, but we just need to actually just add it into, a credit measurement process to incorporate that decision-making process. And yeah, we have a very fully structured approach into investment in the credit, and I think that'll be my time. Thank you very much. I'll give over to you, Vuyo, if there's any questions.
Thanks, Sithembiso, for that informative session. Just in terms of questions from my side, I mean, there's a few questions that have popped up on the Q&A. You can still type your questions if you still like to have questions that you would like to pose. One of the questions that was posed is that how safe are members' pension funds at TRANSNET, given the credit concerns or maybe some of the governance concerns at TRANSNET?
Look, with TRANSNET, I would say if you compare with the rest of the SOE sector, I do not think that TRANSNET is the one you should be worried about. I think obviously we cannot say summarily that something is 100% safe, because there's nothing that is 100% safe. But I think TRANSNET is the best performing SOE on balance sheet when you look at the numbers. So the only issue that almost caused disturbances in TRANSNET, it was the fact that there was governance issues that were interfering with operation that almost took TRANSNET off its trail. But the good thing about TRANSNET that it never got to a situation similar to ESKOM, because you would remember a long time ago, ESKOM was also profitable and generating revenue and self-sustainable. And it's just that, the corruption and governance issues were so entrenched that they could not be, sorted out in good time. So TRANSNET, I think it was solved in good time, and currently TRANSNET is back on its feet and it's operating.
I mean, just to also add on to that, just to remind, people that members' pension funds are ring-fenced to actual SOE balance sheets. So, I mean, if you look at any of the SOEs, not just TRANSNET in isolation, but members' pension funds don't sit on the actual SOE balance sheet. So there is some sort of protection as well from that point of view. Just another question that I have for you, Sithembiso. What do you see the major risk in the credit market currently? I mean, we've seen a lot of flows moving into money market funds as well as income funds. And as you'd mentioned, South African credit markets are not that deep. Do you see investors potentially chasing yield with names that are poor quality?
I think it's highly inevitable that people will be much more tolerant to higher risk, purely because of the shrinkage in the issuers in the market. Or one thing that it could potentially do is to create another market, a bilateral market, where people do not have to go through capital markets for issuance and go directly to issuers, which is something that we've seen. But to answer your first question on the biggest risk that I think exists, I think it is on the property market. So as you saw on the slides that I showed, other than SOEs and banks, property sector is the biggest at 40 billion current outstanding debt. So if you have a wide-scale industry breach of covenants, which is something that we think is, highly likely for some of the counterparties in the property space, and even if some of them do not really breach those covenants, it could have a contagion effect to the rest of the market. So I think the biggest risk is a industry-wide breach of covenants in the property sector that could just trigger a huge and huge default in the whole sector right now. But I think as Prescient, we're currently positioned for that. We do hold property counterparties, but we hold what we think is safe given our due diligence.
Okay. Just another question is that what do you think is the impact of, the announcement that was made yesterday and the signing of the memorandum of understanding between DBSA and National Treasury in terms of the infrastructure fund, particularly because they're looking to partner with both private and public sector, and in the private sector, they're looking at actually getting assets from clients' retirement or savings money?
I believe that's the best way of actually funding government infrastructure, because those were traditionally funded off the balance sheet of the individual SOEs. So now if you insulating those infrastructure projects into a standalone vehicle that does not get interference by governance issues from different SOEs, you'll be basically, so that is basically off balance sheet funding for the government on all these SOEs. So it's an easier way to actually take a risk, because the investor has to be worried only about the performance of the underlying infrastructural project, as opposed to a lot of other corruption issues and also governance issues. So it's easier to actually raise money for that, and I think it is a good exercise for government to actually take that route. And on top of that, I know the government is actually revising that Reg 28 allowance for alternative investment, which would definitely unlock a lot more cash that would chase those type of assets.
Okay. Right now, I'm not sure if there's any questions. If there's no more questions from the audience, I'd like to thank you on behalf of Prescient Investment Management for attending the session. We will be sending out a note to all the clients and broader investment community on some of the work that we've done around the risks in terms of credit in the property sector. And that's all. Thank you.
Thank you for your